morning, everyone. My name is Rob Douglas. I'm the Executive Director of Australian Owner Manager, and we're very pleased this morning to welcome you to this webinar in partnership with National Australia Bank, and particularly to provide all of you with a bit of an economic update. We've had a number of business owners throughout the network, small and large, who have asked a lot of questions around, what does the economic situation look like, particularly when things like JobKeeper come to an end, and what does the rebound of the economy look like. And so we're very pleased today to have assembled a team from NAB that are going to answer many of those questions and provide us with a bit of direction, which in what is, an uncertain environment, and has been an uncertain environment. Australian Owner Manager are a boutique education provider. We provide development programs, particularly for the owners of private businesses, generally focused with businesses with revenues greater than 3 million. And we're very privileged that NAB have come on board as a partner and have been actively supporting the programs that we run, and particularly, helping businesses as they, start to transition and move out of what has been a challenging time economically, with part scholarships for, learning and development type opportunities. So what I would like to do now is just pass to Andrew Loveridge, who's a customer executive in emerging markets for NAB, just to introduce the team at NAB and run from there. So over to you, Andrew.
Thanks very much, Rob, and thank you to all the participants who are joining us today. We know that you're extremely busy, and hopefully this will be an insightful meeting for you. As Rob mentioned, we've got a wonderful partnership with the Owner Manager program, and we're very proud of that. And hopefully today we will help you, our business communities, make a bit more sense of what's going on with COVID and the impact that may have here and also abroad. I'm joined today by my colleagues, Alan Oster, who's our Chief Economist, and Lucia La Bella, who's our Customer Executive of our Commercial Real Estate portfolio, and Nguyen, who's our Associate Director of Emerging Sectors. I'll shortly introduce you to Alan. He'll talk a bit about the economy and what we're seeing, and also talk a bit, and then introduce you to Lucia, who'll talk a bit about the property side of things. But we'll also have an opportunity to do some Q&A, and we already have received some questions prior to the session starting, so we'll run through those. But as we go through the session today, if you have questions you'd like answered towards the back end, please submit those via the Q&A function in the Zoom profile. So before I introduce you to Alan and Lucia, I'd like to say a big thank you to both those. They have probably done webinars, podcasts, vodcasts, till the cows come home over the last few months. So a big thank you to both of you for doing this for us. And with that, Alan, I'll pass to you to kick things off.
Thanks, Andrew, and welcome everyone. Yeah, I do a lot of these Zooms. I've done 2 this morning, believe it or not, already. I suppose what we're looking at, everyone uses the word unprecedented, but it is unprecedented. And basically what we're globally looking at, and then I'll talk a little bit more about Australia, is the impact of closing down economies to essentially deal with the virus. And we've never really seen this before. In terms of the degree of falls and the speed of falls that we're seeing offshore, they are massive. And so, typically what we're seeing in Europe, in the US, UK, you're going to be looking at falls in GDP of 15 to 20% in the June quarter. And typically we're hoping that things bounce back a little bit, but I think you do need to be very careful about when people talk about these. It's certainly true that in terms of growth rates, you get that. but in terms of levels, it's more like an L, or maybe even a U, but it's an extended U. So to give you context, when we look at global GDP, our best guess is about minus 3.8 for this year. The previous all-time record bad year in the post-World War II environment was 0, which was during the GFC. So this is very different. It's also very different both offshore and in Australia in relation to how the labour market has behaved. Typically in a recession, people initially cut hours and then eventually they realise this is permanent, and then they basically start cutting jobs. In the US later this week, the expectation is the unemployment rate's going to rise to 19.8, call it 20%. And that's 2 months ago, it was 3.5. So you've gone from the lowest for 30 to 40 years to the highest read we've ever had in the post-World War II environment in the US. And, you know, and Australia, if I had to sort of summarise it, both on the virus and in relation to the economy, has done really well. Having said that, I'm going to now talk a little bit about Australia, and a lot of this is not going to sound pleasant. Essentially, all the data we see, and we look at internal data. So one of the things we spend a lot of time on is building a capability. So every Tuesday or Thursday of each week, we put together what's happened right across all our electronic transactions for the week ending last Sunday. And we put some numbers out yesterday. What it's basically showing is essentially what happened in the Australian economy is the real problems occurred in the back end of March. So yes, you had really big problems in hospitality, international tourism, and that sort of area, but they were offset largely by hoarding and retail, supermarkets, things like that. So you're going to get March quarter GDP next week, and it could even be, well, we think it's a small negative, like a minus 0.1. Your average is going to be something like 1.6, so it'll look fine. The problem is what's happened subsequently. And if you're looking at our data, there's two things I could show you. Number one, I could show you a business survey taken between mid-February and mid-March that had no impact from the virus. And then we had an end of March one, and what we saw was confidence levels 3 times worse than what they were at the bottom of the global, or of the 1990 recession, which was the last big one. We've already got forward orders significantly worse than what it was at the bottom of the 1990 recession. And roughly in 6 weeks, we've seen 10% of capacity utilisation disappear. Where are we now? As of last Sunday, we look at the economy or total consumption, which includes retail. It's down around 12%. About a week ago, or about end of April, it was down 15%. So what I'm sort of saying to you is there has been massive damage done. It's not as if, is this still coming? It has happened. The good news I can tell you is essentially that the rate of fall has stopped. As of the last couple of weeks, we've seen a small pickup as things start to reopen. Our expectations, and they're sitting pretty consistent with what data we've got, say that maybe after a flat March quarter, June quarter will probably fall 8 to 8.5%. You may have seen the Reserve Bank governor coming out and saying it's a bit better than they hoped. Well, they thought it would fall 10. So we're still happy with, well, not happy, but we're still expecting -8. We're hoping there might be some recovery in the September quarter, and then you get a big recovery in the December quarter when things open up even more. So we have Australian GDP down around 4%, 4.25% this year, and down about 4 or up 4.5 sort of thing next year. So it looks like a big V. And in growth rate terms, think in simple terms, down 8%, up 8%. So that's where people talk about the V. The problem is if you drop from 8%, drop down 8%, and then you basically go from that lower level up 8%, you're not where you started. You're still below. And on our forecasts at the end of 2021, we will not be back to the level that we achieved at the end of last year. So if you're talking about levels of GDP, you're talking significant impact and talking long-lived in terms of its impact. Now, the other thing that we see is very big increases or very big hits to the labour market. So you may have seen that the labour market for last month lost around about 900,000 jobs. Previously, the all-time record, 594, so 600,000 jobs. The all-time record previously was 74,000. The reason unemployment didn't go through the roof was, particularly in the dole, or what they call job seeker at present, you don't have to actually go looking for another job. So if you're in hospitality, clubs and pubs, they're not open, and you want to stay in that industry, you're not actively looking. And so the statistician treats them as not part of the labour market. And so there's a massive fall in what we call participation rate. Internally, when we look at our numbers, we can see anybody in NAB who's a customer who's actually receiving the dole. And that implies at present about 10% unemployment. So the unemployment rate is going to continue to go up. It's just, you know, at present, they're not counted as actively looking for jobs. The government will change the rules, and from July, they'll be saying, hey, you've got a social responsibility to go and find a job or go looking for one. And so that's going to be a problem. Sorry, I'll turn that off. So we see unemployment up around 10% by the end of the year. We see unemployment at the end of next year still with a 7 in front of it, which is what the government also thinks. And when we extend our forecast out to 2022, we've still got a 6% unemployment number. Now, a lot of people ask me about how sustainable can the government do more? I think the government's moved really quickly, really well. It's tried to keep people attached to the labour force. It's tried to essentially give support to people who have lost their job. So I think that's been really effective. Now, I know it's incredibly embarrassing when you miss your estimates by 60 billion. But what has to happen is when you come the end of September, you can't just turn everything off because that will not help at all. So I would expect that what the government will have to do is look at things like JobKeeper and say, okay, if you're in an industry that is catastrophic or still got really low levels of turnover, and there'll be people like anything to do with international travel, obviously. I think commercial property is another area, anything to do with population growth, because population growth is going to halve. I don't see international travel outside of New Zealand being reopened until at least this time next year, which means population growth instead of 1.5% is going to be about 0.7. And that will cause lots of grief for some of those industries. So you could still continue to support them. I don't think you need to basically go back to the old New Start, which was about 600 a fortnight. Currently, they're paying 1,100 a fortnight, I think somewhere in the middle. And anything you can do to support some of the sectors that are badly hit, like construction, maybe you go into public housing, maybe you try and do anything you can do on infrastructure to try and help this economy recover. Most economies have spent 10% of GDP. So have we. I think we need to spend more. Because to me, if you spend more, you'll help the economy get going. There will be some parts of the economy that have a structural change, big time. So an obvious one is we're all doing Zoom. And so you don't need to have all your staff in CBD offices. And I think just at present, you've probably got a situation where you've got a massive oversupply relative to the new normal when you go back to the new normal. And so that for me says commercial property and anybody in the SMEs or any space that's sort of providing goods or services for office workers who ain't going to be there, that's a problem. I can see house prices, two big drivers of house price, or three big drivers that basically, number one, interest rates, which ain't changing. Number two, population, which is just half, and the level of unemployment. And normally when level of unemployment goes above 8%, you get a lot of stress. So I think NAB internally, we're now up to almost 100,000 people applied for special support in the housing situation. And we're looking at those customers to try and see what we can do. So there'll be a lot of concern about what happens when a lot of these welfare payments start to get wound back. And just to give you a feel, the other thing that we're seeing in our internal data, particularly in April, was when we look at the cash moving into an account and the cash moving out of the account, the two things have happened. Number one, the reduction in wages, if you like, and employment has been largely offset by the government's packages. Also, we're seeing consumers selling assets, and in some cases, we're seeing retrenchment pays that are being there. So they sort of got the same amount of income in April, but they're down in their spending by 10% because this is not going to be sustainable. You can see other sectors, particularly anything to do with technology. You can see some areas of manufacturing, such as medical, hospital. People will look at China and say, do I really want to have the cheapest, or do I want a bit of security in my chain of production? And so I think those things are going to permanently change. I've probably almost done my time, so I better move on quickly. So for us, I think it's really important to understand a couple of things in terms of levels. This is more like an L or a U, not a V. You will get a V, but large chunks of the economy struggle. I'm hoping that we won't get phase 2 and phase 3 of an epidemic coming back. I think we're in a good space. I worry a lot about the reopening in Europe and the US, and particularly what it might mean to Africa and Latin America and places like that. So I don't think we're out of the woods there, but Australia's in a good space. If we spend a little bit more time and a bit more money, I think we can come out the other side. But it's, before you get back to what you might think normal, it's probably 2 to 3 years away. In terms of the other thing that's going to be very different is wages aren't going to be increasing much. I think a lot of people know, particularly owner managers will know that there's a lot of vacant apartments out there. CBD, Sydney, Melbourne, the foreign students aren't here. And so half of them are empty, B&Bs are sort of empty, people not travelling. I mean, there will be opportunities in the local travel. There'll be opportunities, obviously, on anything to do with technology and some parts of manufacturing, but it's going to be tough. The other big thing is if you've got wages growth of around 1%, so that's just basically the bottom end national wage case plus the rolling over of some agreements that were 2 or 3 years set. If wages growth is around 1, inflation's 0 next year, and it's going to stay like that. And so one of the big things that the Reserve Bank's not telling you is inflation is going to be way lower than what they're expecting. And, you know, we asked the Reserve Bank privately when we meet with them, you know, okay, we can see your forecast, we're a little bit more optimistic than you, but how the hell do you get your inflation number? And the answer is, that's a good question, Alan. And they smile at me and say, a good question, but they don't say anything else. Because if they're out there saying inflation next year is close to 0, they need to do more. Now, I don't know how they'll do more. I suspect all they'll do is basically just keep the yield curve, in other words, the 3-year bond rates around about where the cash rate is, and that flows through into the yield curve and helps a bit. But my key message is a lot of the damage has already been done. We are miles better off than most of the countries around the place, and the Kiwis as well. They had a very small economy. They just killed their economy. I've seen estimates up to 25% down in the June quarter in terms of GDP in New Zealand. Overall, let's not kid ourselves. This has been a massive hit. You may get this funny idea that, let's say, March is positive and September's positive, so we don't get 2 quarters in a row of negative growth. Sorry, this is a recession. This is a serious recession, and we haven't seen anything like this ever. And, you know, data going back to World War II, before that, maybe the Great Depression, but we didn't have quarterly data in those days. So I think it's a very challenging environment. So I might stop there and hand over to Lucia, who's going to tell you all the wonderful things about commercial property.
Over to you, Luch.
Thanks, Andrew. Thanks, Alan. So thanks for being here today. It's great to get an opportunity to talk to you about commercial property. Speaking along the lines of what Alan said, commercial property has had quite a large hit in terms of the last couple of months. And the way we look at it internally at the bank is investment versus development. So if I start with kind of the investment side, what I'll do for you is give a bit of a flavour for each of the sub-asset classes because they are behaving differently. So speaking about office, and, you know, Alan mentioned this as well, if we start with the office space, it was tracking really well prior to COVID. So there was a lot of new supply coming online, vacancy rates really low, rents kind of were increasing. So it was an asset class that was performing really strongly, and it was a large growth area, especially in Victoria and New South Wales. Unfortunately, now given the situation, and as Alan mentioned, the working from home consideration, large organisations, even like NAB, are thinking about what are the longer term impacts of working from home, you know, percentage of the workforce being at home all the time potentially, or at least 1 or 2 days a week. As large corporates start to think about that across the nation, that will have an impact then on the space that's been taken up. But the other factor to consider is then also the social distancing component. Like if I think about NAB in our larger offices, we're pulling out desks to kind of create extra space, not using the meeting rooms, etc. So there is a component for some businesses of the spatial requirements. So it's working through, you know, how many people do you have in the office, and then how far apart are they? We kind of see the metro locations being harder hit with the larger office spaces, whereas, you know, your smaller office spaces, if you think about more in your suburban areas where you've got medical tenancies or smaller businesses, they're actually performing quite well. Obviously, initially, if you think about the medical industry, a lot of that was obviously kind of stopped completely to start with, but that's kind of, you know, allied health and specialists have come back into play. So we see that the real understanding, I suppose, as a landlord in the office space is understanding your tenancy mix and that future impact of income and working with your tenants and really understanding those. So when we're making assessments of future projects or either development or investment in the office space, we're really suggesting bankers work with customers and landlords to understand their tenancy mix and diversification. If you've got a building where you're reliant on one specific tenant and it's in one specific industry, I'd be more concerned as opposed to if you had a mix across. And, you know, to share Alan's sentiments, you know, that those metro and larger locations are the ones that we're watching really closely. And I would suggest there's not going to be a lot of new activity in that space, given there's already a fair bit of development occurring at this point in stage, and that needs to already be taken up by the market. So I would see a bit of repurposing happening in terms of new development in office and potentially into resi or to other sub-asset classes. If I then move to retail, and let's be honest, retail was suffering significantly prior to COVID. We were already monitoring retail exposure very, very closely. You only had to pick up a paper and see a headline, and there was, you know, another chain of stores either shutting down or closing up. So that was having a few huge structural changes. One of the things, we've been talking to large holders of retail property is, what are the shifts that landlords need to think about in terms of turnover rent in order for retailers to be profitable into the longer term, given that shift to online that's occurring. If we think about large format retail, looking at customers in terms of rent received over just the period of April was down 60% on what they collected in March, and in some cases, 100% down. So huge impacts. And to Alan's point, it doesn't mean the next month you pick up your rent and you're back to where you were before. These kind of things have long-term ramifications on the value of retail. We were already expecting for customers that had retail property and maybe potentially had a valuation 3 years ago that there was already an inherent decline in that value. And then we expect, decline again. So I would suggest from a retail perspective, we have a lot of customers that have a trading business and might have a retail shop or two on the side that they've rented out. Strip shops and large format retail are the two components that really probably will be the largest hit. And they're the things in terms of working with valuers and what that means. And we can talk about that a little bit later in terms of the impacts of that. Whereas if you think about your neighbourhood shopping centres where it's anchored by a large supermarket like a Coles or Woolworths, they're faring quite well. So they're still collecting, up to 70 to 80% rent at this stage, given the supermarket component is that large portion of the income. And then it's, the small tenancies as part of that shopping centre, like you might have your nail bars or travel agents, etc., that aren't operating. So the rent from those kind of tenancies isn't coming through. So another one to think about is your mix of tenancies, who are the underlying industries that you're exposed to, and it's really having a good understanding of those underlying industries to make sure when you're thinking about if you're earning income from commercial real estate, it's not just the industry you're in, but those sub-industries of tenants and their operations and performance. I do have a good news story for you in terms of commercial real estate. So shifting from the negatives, industrial property is faring really, really well. So we've been following that quite closely with our customers. Supply chain, warehousing, logistics is all going really, really well. We feel like there will be a shift in terms of, we've been very reliant on overseas in terms of manufacturing, and I don't see it shifting 100%, but I think there'll be a shift back to stuff being manufactured on shore in Australia for certain sub-industries. So I think that will have an impact on this asset class longer term in a positive way. We're seeing customers still earning, 90, 95, up to 100% of rent in those asset classes. So industrial faring really well. The only one minor caution in industrial is if you think about those service shed locations where you might have those tilt-up walls, with the large locations that are split up, some of those will have access to things like gyms or rock climbing or play centres. Those types of tenancies have obviously been impacted and are still kind of on watch. So dependent on your diversification mix, but generally in the main, in industrial, 95% of tenancies are doing really well, and we see that to continue. So that's a sub-asset class. I was asked this question surprisingly 18 months ago at a forum in Sydney, what would be the asset class you would invest in if it was up to you and your money? And industrial's been one of the ones I've always maintained, I feel, is a strong growth area for Australia, and depending on the corridor of where you're located and the assets you look for, and we see that continuing. So, that is a positive news story. Tourism and leisure, on the other hand, Alan mentioned this, the travel component of that is having huge impacts on this industry. If you think about hotels, in some instances, zero income. And so my fear for this asset class is what will cap rates do with valuers, in the short to medium term. They're looking to kind of rise to 5 to 7, which, will have a huge impact on valuations for hotels. And, Australia is just so reliant on that international travel component and our entertainment piece. If I think about Victoria and New South Wales specifically in terms of sporting events and concerts and all the things that attract people from overseas, the hotel component of our economy is really kept alive by that entertainment and travel component. So for us, we do see subdued income in those particular areas. We're working with customers at the moment to give you an idea. They're in the process of looking at doing refurbs of hotels, etc. They're suggesting, what do we do here? Where before your feasibility might have looked at, the valuation increasing 20, 30%. in the short to medium term, I don't suspect that will happen anywhere anytime soon. So we're being very cautious around any new development or, refurb, etc., in that kind of hotel space. So that's one I'd kind of stay clear of. Pubs is an interesting one. It really depends on the underlying business, the location of the asset, which state it's in at the moment as to whether they've even commenced operating, how far we take social distancing in that short to medium term in terms of, for an operating business to make money, how many people do they need kind of in that location to make the numbers work. And so they're ones I think you just need to look at on a case-by-case basis, very dependent on the location of the asset and really the underlying operations of the business and how well they manage their cash flows to, have they got their cost base low enough to be able to trade through this time until they can actually get to the levels that they were prior to kind of COVID happening, or will that ever happen again, given, this social distancing and how that will continue. So something to kind of keep watch of. If I then flick to development's an interesting one. So luckily, leading into COVID, there was actually less development on the card. So if I think about back to 2017, where we had a huge amount of development hit the market all at the same time, had COVID hit then, we would have been in all worlds of pain in terms of there was huge supply of residential development coming onto the market, especially in Victoria and New South Wales and, in all states, but those two markets particularly, we did have less developments occurring. So if I think about even just NAB specifically, we were down around $2 billion of development lending just in our book over the course of the last 18 months. So that's just a huge amount of development activity that had reduced in the market. I was initially very concerned about quality of development, and actually initially we were thinking about all the input costs. Like if I think about, materials like glass and facade items out of China, what that would do in terms of the speed of projects and would that slow down practical completion times. Luckily, that hasn't occurred too much. So there has been some slight delays, but not to the extent that we were initially anticipating. Where there has been delays is in your high quality projects where you've got things like tiles coming out of Italy or lifts out of Germany. Those types of products are still quite difficult to source. So they're having some delays in residential development projects. So that's quite interesting. Speaking to developers and builders, what I've been really impressed is their ability to actually implement social distancing requirements really quickly. What that has meant is that you don't have subbies all on site at the same time getting in each other's way. So what they have actually found is productivity has increased on development sites. Silly things you don't even think about in terms of traffic being less means getting to and from jobs and work sites and delivering product to site has been a lot easier. We have found with the projects that have had practical completion over the last couple of months, there has been a degree of settlement stress up to about 10 to 20%. So what we've found there is from the bank's perspective, we've been able to, our funding's been repaid, but what it has meant for some developers is their profit margin that they would normally get on a project is under pressure, given there's been some purchasers that have been unable to settle or have asked for extra time to settle. And that goes to Alan's point around, JobKeeper, JobSeeker, all of that type of support from the government. If that gets cut off very quickly, that will continue to then have an impact on the residential market. If there's continued support from the government to help with demand, that will continue to support, the residential development industry. We are speaking to government around, what things can they do in terms of land tax, stamp duty relief, first homeowner grant, incentives. If I think back to, the early 2000s, we had large incentives for first homeowners to kind of get the economy moving again. There's things like that we might need to revisit and reconsider just to ensure there's still demand. We will have the impact of lower immigration. That will have an impact obviously on residential development, especially in Sydney and in Melbourne specifically. Those markets and, the trajectory of the residential development needed was very predicated on that huge amount of immigration that we still needed. What I have been tracking very closely is residential valuations, and they have been at contract price and in only a few instances up to 8 to 10% below contract value, not huge shifts at this point in stage. So I'm comfortable right now, but, it depends then on the supply, and if there's too much supply, and, as Alan said, then if there's not that demand there, will that have then an impact on residential pricing going forward? We're hoping, and, as a banking industry, working with the RBA and APRA around maintaining and ensuring as a banking industry, we support a certain level of supply to keep the building industry going. But the bits we can't impact is what does the second tier funding market do? So that's an interesting point. We had a lot of developers that the metrics didn't make sense from a banking perspective, and they were going to that second tier private money market to get funding. Those funders have increased rates significantly because obviously the risk margins increase, and that really has quite a large impact then on the profit margin for a developer. So it's good to keep those things in mind, and I've noticed real flight to quality and back to banks for inquiries around development funding. One, because obviously we don't have such a large risk premium, but also we're very cognizant of the metrics that make sense. I would say if you're in development or something, you're involved in, feasibilities are just crucial right now, and revisiting them on a weekly basis. As business owners, I'm sure you're looking at this yourselves in terms of understanding your underlying cost structures. I come from a family business background myself. Doing those feasibilities, making sure you have enough contingency in the project from a development perspective is really crucial to ensuring success of a project. And just ensuring you understand who's the builder you're working with, what cash flow issues they may have, how many projects they're working on. Not necessarily taking the cheapest quote's always the best outcome, and we all know this from business. In anything you get a quote on, the cheapest price doesn't mean you always get the best outcome, and that's certainly true in development. NAB specifically has an internal quantity surveyor team. We scan the market, work very closely with a lot of builders, and it's something we monitor and manage really closely, and give advice to customers and bankers in terms of where we see hotspots and strains specifically within the market. So that just gives you a bit of a feel for what's happening across the property space. They were kind of the few questions I've asked. There was a question around valuations and what might occur there. So specifically what NAB did early on is we took a stand that we wouldn't actually do commercial valuations over the next 6-month period, and we worked with the regulator on that. And that was specifically, we found valuers were at very varied ends of the spectrums of where they thought valuations will land. And given we didn't know what would happen over the short term, we wanted to kind of put a hold on valuations. What we are doing now internally, however, is working with valuation firms and getting a house view on what are the ranges we think will happen for each of the sub-asset classes. Then start to look at, okay, what are our customer base that potentially might have a high loan to value ratio position? And if there was to be a decline in valuation, what would that do to the equity that they have in that particular asset? And start to think about things like potentially in commercial property, we did a lot of interest only lending. To be honest with you, I see a shift moving back to P&I. Just given customers building equity back in the assets that they own, and that will be especially true for certain asset classes like retail, where we see larger impacts potentially on valuations, whereas industrial, for instance, we don't see that occurring. So it will be very bespoke, case by case, working with customers to work through what that might look like. The intent of the bank is not to sell everyone up day one and say, all right, your LVR's moved from 60 to 80% and see you later, we're selling you up and move. That's not at all the intention of any bank. It's not in anyone's best interest to do that. But we need to ensure that as for our customers and for us, we kind of get on a pathway that helps customers to build back equity. Might mean restructuring. It might mean moving cash flows from other things to kind of help with that position. It will be very case by case. If I think back to the GFC, it was very bespoke depending on, the individual circumstances of customers. And NAB, I have to say, I've been quite impressed. I've only been at the bank for a few years, but in terms of that process, in terms of working through when we are under stress, how we do that with the customer, I'm quite impressed in terms of how we do that. So that just gives you a bit of a flavour for what might happen on the valuation side as well. Thanks, Andrew. I hope that covers what everyone wanted to hear.
No, thank you, Lucia. That's great. And thank you, Alan. Both very insightful presentations. Now, we want to go to a Q&A, and we do have some pre-prepared questions that came through prior to the session, but there's also a couple that have come through on the Q&A as we were speaking. And what I might do, Lauren, is I might, and I don't think you can actually read that one, but I might actually read this one and throw it to Alan. And then, Lauren, I'll get you to pick up on the pre-registered questions, if that's okay.
Yep, that's fine.
Okay. All right. So, Alan, here's one for you, and it relates to sort of geopolitical question. It's from Graham. He asked, Alan, how do you see the Australia's deteriorating relationship with China affecting the Australian economy?
Yeah, I get asked that one a lot. In the next 12 months, I don't think it's necessarily going to be a big issue. Why? China's just had another round of stimulus after their national convention. And so they're going to need things like iron ore and coal. The issue is obviously that they may move beyond just barley and meat and things that they're sort of using for political reasons. I think the government's trying to play it all down. Clearly, we're not getting international tourists and we're not getting education anymore. And so that's an issue. If it deteriorates and, you know, who knows what's going to happen. I see this as a 3 to 5 year thing that could be significant. It will make us, I suspect, more resilient in the sense that we will not necessarily just take the cheapest price. I think that's one of the big lessons that people have learned, that, you know, you get the cheapest price, therefore China always devour, and away you go. I think the analysts say, hang on, if we get another problem, isn't it better if we have a supply chain that comes out of Australia? And so I think that's going to happen. So it's going to open up opportunities. So short term, I'm sort of not that worried. You know, it's awful if you're a barley producer, but they'll sell it else, albeit at a lower price. But I think in the medium term, that's an issue that's really difficult, and it could well be more significant, although it will open other opportunities.
Okay, thank you. And Lauren, I think you can now pick those Q&As. I think there's one, there might be two other that have come in during the session.
Yes.
I can see one from Joe and one from Vicky. So
yes. Yep.
Let's pick up Vicky. That one for Vicky can probably go to Lucia, I suspect.
Yes. So Lucia, there was one question from Vicky in relation to the childcare property values. The impact on childcare. I mean, you did mention briefly, about NAB putting a hold on commercial valuations, and we're having discussions with our valuers how we are going to approach valuations going forward. But do you have anything specific to say on childcare?
Yeah, so childcare is an interesting one. We've got that one on watch, not specifically because we think there are structural issues with childcare. It was more, obviously, given government support, there were obviously childcares were closed, not as many people were using childcare facilities. Now probably wasn't the right time to be going into new opportunities. So we were suggesting to our customers, put kind of those things on hold until we understand fully the government support, understanding the location of the asset, who the operator is, what the income streams are, etc. So I would suggest over the next month or two, once we get more clarity and that kind of part settles down, then we can make some assessment in terms of what will happen there. I'm hoping valuations there, we've started talking about that, aren't going to be as impacted, for instance, as retail, etc. So I don't see there to be as huge impacts, but I again think it's very dependent on the location of the asset and the operator, the strength of the operator in terms of how they manage income and what that will then do as a landlord. If you, in terms of the income streams you get on an ongoing basis. So a lot of these things, interestingly, you can have, even to Alan, you can have these views in terms of what you think will happen at a macro level, but sometimes it really comes down to the individual metrics and understanding of the transaction, and quality, location, costs, cash flow management are just so important when it comes to commercial property. Very similar things in terms of running a business. you can have the best brand, but if you don't, manage your cost base effectively and etc., then you don't have really a profitable outcome. The same is true, as a landlord and earning rent in terms of the underlying operations of the business is super critical and staying close. I would say what this crisis has done is meant the relationship between the landlord and tenant will probably be more open, and so there'll be more access to information on an ongoing basis, where previously we used to just rely on maybe a tenancy schedule once a year, looked at the bottom line income number, worked out what the interest cover would be, tick that off and move on. I think those days are gone. I think we're going to be going back to revisiting underlying, future cash flow forecasts, etc., and staying close to landlords and tenants together, and the bank, to be honest, as a kind of three-way partnership. So I think that's some of the shift that I think we'll see in commercial property going forwards.
Great, thank you, Lucia. So Alan, so we've got another question for you. So someone's asked, so will the government, so what do you think about infrastructure projects? I think what they're trying to say is, will the government need to continue funding or even increasing funding of infrastructure projects to keep the construction industry afloat?
Yeah, infrastructure is really important. One problem with infrastructure is that normally it takes 3 or 4 years when you do a plan and then it'll go up. So let me give you the example. I was running forecasting modelling in the Australian Treasury in the 1990s. And so they had a big infrastructure project that was going to help 1991, 1992. It actually hit the books in 1995. So what you got to do is, if you're spending anything, do it now. Don't just sit around. So if you do maintenance, anything that you can bring forward 12 months, that would help a lot. I don't mind the idea of let's go out and do a lot of building for public housing. The other one I think you could think about, and this is one that we sort of privately suggested to the government, was no matter what the rules are at present for getting an approval, for the next 18 months, it's half what it currently is. So if you're going to have an approval that normally would take you 12 months, it's now gazetted, it can only be 6 months. And that way you can bring some of that stuff forward. But infrastructure is really good, particularly if it's for longer term improvements, but you need it now. I don't need it in 3 years' time, sort of the problem. And that's what I think everyone's looking for. So a lot of infrastructure is going to be maintenance. Get out there and seal the roads and all that sort of stuff, rather than building a new one or a new airport.
I agree, Alan. I think one of the key areas is that public housing piece. At the moment, it's really the institutional players where the funding models and the returns make sense. I think there's a really big opportunity for private developers and smaller companies to get involved, but it requires government support to do that in terms of the ease of getting through restrictions, being, the cost-based structures that are currently a bit prohibitive for the private sector to be involved. But it's an issue that will continue to get larger and larger, especially with COVID, in terms of the need on the demand side. So in terms of supply, why wouldn't we get private developers involved to support? So I think it's a huge opportunity that we can work with government on.
We're hearing a lot of words like shovel ready and red tape. So yeah, you're spot on. Lauren?
Yeah, okay. So this is one of the questions that was asked during the registration stage. We've been getting quite a bit of property related questions. In terms of residential construction, are you seeing, do you think that there's going to be demand for more, there's going to be more supply out there, Lucia? Or I guess, now that we've sort of closed our borders, we're not actually having, people coming in anymore. Do you see that there will be like an increase or reduction in residential construction?
Yeah, so I think I kind of covered it previously, but I don't see an increase in demand. Unfortunately, a lot of the supply and demand numbers were predicated on that immigration component. And as we've discussed, that looks to be reduced for the coming few years. So I definitely don't see there to be an increase. It will I really think, to Alan's point, dependent on what happens with unemployment figures and that impact then of income for people. It's really the confidence in the market. If you're comfortable that you're going to earn income, your job's secure, you start to think about things like moving house or upgrading or changing where you live. If you don't have that confidence, people generally like to sit on their hands and stay where they are and just wait and see. And my husband's in residential real estate, so I stay quite close to what he does as well to kind of complement the commercial side. And he's just seen, and this is across the board, listings are down significantly because people just don't know what the short to medium term holds for them. So until we really start to see listings increasing and activity, I think, people going out to auctions, they're interested to see what's happening. There's inquiries still occurring, but I'm not seeing people signing on the line for new purchases, for instance. There is people interested, there's inquiry, but I think pre-sales for developers will be harder to obtain. So really that's where we need to make sure we don't oversupply the industry in the market all in one hit. But to be honest, given the amount of projects going on, I don't see that to be an issue. It's more than what types of projects we fund and support and put onto the market that meet the need of the purchaser. That's really important. One thing I'd like to also add is we've had a couple of projects where there was a higher FIRB component. So, and what that has meant is for those developers, unfortunately, that money coming out of Asia has been harder to get out of Asia over this period. So for those developers, they've had to hold those apartments and like the purchasers still want to purchase, but it's going to take a lot more time to get the money out of China. So that's meant a cash flow strain on them. Luckily, these particular developers had enough cash flow to support. Otherwise, they may have had to look at potentially reselling the apartments. And that, if that stuff starts to happen, that does have an impact on values if you need to start reselling stock that had already previously sold. And especially if it's under duress, if that does start to happen more, you will start to see an impact on property values. We're not seeing that at this stage, luckily. And that's why banks generally have that FIRB component, maximum of 20%, so that we avoid that occurring as much as possible. So I just thought I'd kind of mention that as well.
Yeah, I'll just make one other point. If we go back and think about where was the construction industry prior to COVID, the answer was it was halfway through a 20% reduction. And this is not helping. And so I think it's quite interesting when we do our business surveys, construction is actually one of the few that's still doing okay because it wasn't closed down. But when you come to their confidence ratings, they're like -70. They're about as the most negative you can possibly have. And what I hear out of Canberra is they're looking at doing some sort of special package in the construction space because that's one that they're really worried about. Not so much about what's happening now, but what does population, if there's only half the growth in population, and I think all the banks are moving away from investor back to owner-occupied sort of lending. So it's going to be tough, I think, and certainly it's not going up.
Okay, great. So I'm just conscious that we've got about 5 minutes left, and we've got a couple of questions left. So we'll try and get through all of them. So there's just a question about any thoughts or comments on the disalignment of the governments, between the local, state, and federal. Whether there's a need for all three governments to come together.
Okay, I'll have a go.
Very hard.
Okay, so let me give you an answer that might surprise you. I've actually thought the national cabinets work really well. And particularly when I look offshore, I think, well, you might not like either side of the strap, but God, they look good compared to offshore. And, compared to, it works so much better than COAC because privately everyone used to say, if something's too hard, I'll just put it in COAC and nothing will ever happen. So I'm a little bit more encouraged that the governments have all tended to work together. Maybe it's fraying a bit at the edges now, but I'd actually like the national cabinet to keep going because I think they are all it's in a crisis and they're all pulling roughly together. And so therefore I think it's pretty good.
Okay, great. So we'll probably finish off with maybe one more question. So it's just around the recent, I guess, passing down of, with the casuals, how casuals can actually get sick leave now and annual leave. What do you think the flow through impacts on the economy will be by, casuals getting these additional benefits and, and the impacts on the businesses?
The number one thing Australia has to do in this post-September period is get more money into the consumer's balance sheet. So either you do it through JobKeeper or JobSeeker, you give more to the casuals, or you give big tax cuts. And okay, maybe they won't spend it straight away, but it'll make them feel more comfortable, make them feel that they've got a job, and they will eventually spend. But in the current environment, we're not seeing people necessarily falling over, but they're really stressed, and therefore they're not going to spend. So you give them the same amount of money, which is what the government's done, they're not spending it. And so to me, we were asked, if there's one thing, what would NAB say to the government you need to do? And our answer was, get more money into the consumer. Now, I'm not interested in corporate tax cuts. I'm not interested in all those other stuff. Get more money into the consumer. So the more you can do that within reason, the better. And so that's sort of my answer to that question.
Great. No, I think that's all the questions for now. So so back to you, Andrew and Rob.
Rob, I might pass to you, but before I do that, I'll just quickly thank my colleagues, Lauren, Lucia and Alan. So thanks very much for your support of the session. Over to you, Rob.
Thanks, Andrew, and thanks, Alan, Lucia, Lauren. It's been fantastic. We've been richly rewarded today, just listening to your experience and your intellect and just the things that you're seeing in the market. One of the things from a business owner is that often you only see those things in terms of your circle of influence, and so it's really helpful to be able to take the blinkers off and just look a bit further afield, and to be able to converse with people that are seeing things more broadly and at a macro level. And I think we've had that today from both of you, and it's been fantastic. So I just want to thank everyone that's joined us. No doubt there's going to be a large number of people that are also going to be, looking at this and, connecting to this from a recorded perspective. But thank you again from our team at NAB, and thanks everyone for joining us, and hope you have a fantastic rest of the Friday and a great weekend. As what is it, next week, 1st of June, we all start to get a little bit more freedom around the country, which we can all socialise just that little bit more. So and long may it continue. But thanks everyone, and have a wonderful day.